Welcome to Financial Accounting. Thank you for joining in. My name is Samuel Iwanda and I'm your tutor for this paper. This is Financial Accounting and we are here to prepare for the Certified Public Accountants Qualification of Uganda. This is our second class and we are continuing from where we stopped. Previously, we looked at the introduction of financial accounting. And we looked at different areas that involved what is financial accounting, what are the other classes of accounting, like cost accounting, management accounting, and so on. We went ahead to even differentiate between management accounting and financial accounting. And then we looked at the users of financial information. All this is embedded within these notes, and you should be able to have access to these notes in case you're part of our WhatsApp group. So accounting and bookkeeping, the users, the differences between management accounting and financial accounting. And then we looked at the sources of accounting regulations in Uganda, which we shall expound more when we are looking at the accounting framework, the financial reporting framework, as we proceed. So today we want to continue from there and we want to start from the conceptual framework. So the conceptual framework is basically a coherent set of accounting theories. It is basically a coherent set of accounting theories or interrelated concepts that defines the nature, purpose, scope of financial accounting. The standard, basically what I'm trying to read there is a standard definition of our conceptual framework. But it's other literature go on to call it, as it is called conceptual framework here. It can be defined by other scholars, okay? I don't want to give you a complicated definition, but what you have to know with the conceptual framework, the main objective of the conceptual framework is basically to give us guidance, okay? It basically provides us guidance and objectives of financial reporting, okay? This financial so-called conceptual framework is designed by the accounting bodies. The Financial Accounting Standards Board is one that came up with this conceptual framework. And like I said, it basically is a body of interrelated objectives and fundamentals. And the objective is basically to provide the goals and purposes of financial reporting and the fundamental concepts that underlie those objectives, okay? So the reason why we again provided with this is to also provide guidance in regards to selecting transactions, in regards to events, circumstances that we may need to account for. And it also helps us to give guidance in regards to how these will be measured, reported, and summarized. So it gives us the foundation of how we should practice our accounting, or how we should be able to prepare financial statements, okay, as we shall proceed on terms of the contents, okay? So to the regulators, our international standard setting boards, it's based on the conceptual framework that they set standards, the standards like IS1, IS2, the international accounting standards, and now we have the IFRSs. So the conceptual framework enables the regulators to set standards that are coherent in nature, that are logical in nature. As accountants, of course, it provides us with guidance on the day-to-day accounting and reporting, but especially where even we don't have a standard, there are certain things that we don't have standards for yet. Certain scenarios, for example, we got into COVID and people were asking, how do we report for, let's say, COVID funds from private entities to government? How do we even record them? We don't have a standard. I know we had standards around events after the reporting date, but we didn't have like standards that fit within well. So that's why you see now we have new developments in standards. Recently, there's a new standard for insurance, and that mainly affects people, organizations in the financial services sector. We've seen IFRS 9 that is also very new, IFRS 11, and so on. So we have standards that are continuously come up, but where we don't have a standard, then the conceptual framework is very key. And of course, it also, the conceptual framework also helps us in understanding the financial statements. We appreciated the users of financial statements, and we say that we have internal and we have external users. And we say that internal users, their main focus is to use the financial statements to make decisions in regards to how to run the company. External users, their needs vary. If this government is looking at to see how the organization is performing, and the interest is to see, are they paying the right taxes? If it's NEMA, are they accounting for environmental costs rightly, making provisions, okay, where maybe they have an environmental impact that needs to be restored, and so on. If it's investors, they're looking at the potential in the organization. The shareholders, they're looking at aspects of, is there a dividend for them? Banks are looking, are you potentially ready to take on a loan? How are you indebted? How is your debt? And so on. So that's basically the conceptual framework. So the conceptual framework has what we call fundamental qualitative ethics of financial information. Now, we've understood that accounting information is very important, especially to the users, and it's important for the various reasons that the users want to use the information for. Now, for that information to make sense, for it to meet the needs of the users, there are certain ethics that this information should actually have. And the conceptual framework calls these the fundamental qualitative ethics of financial information. So the first that we have is relevancy. And then we have the other, which is called faithful representation. So I'll start with relevancy. Now, for information, for accounting information to be useful to the users or to be relevant, means that it's available, okay? Its availability and use will result in a better economic decision. What means that, remember, if management wants to make a decision on, let's say, if it will give dividends to shareholders or not, then the information provided should be able to tell them whether they have made a profit or loss, to enable them make a decision on whether to give dividends or not. If it's a use of financial information like a bank and they want you to look at your financial statements to determine whether they should give you a loan or not, at least somebody should be able to make a right decision out of that information, that accounting information. Similar to relevance, the financial accounting information should be able to predict the future, okay, with a high degree of certainty. Financial accounting usually is looking at, of course, financial accounting mainly looks at historical information, of course, looking at also the perspectives of the future, but mostly historical, how the organization has performed. But as you proceed, all aspects like management accounting, which management usually uses to make decisions, goes ahead to even look into the future. So any information, accounting information, should be able to help management to predict the future with a high level of certainty. And then it confirms and changes you. All right, so I was trying to say that relevancy involves different aspects. For information to be relevant, it should have different heuristics, which I've been able to list there. But just from your understanding, if, for example, I was presenting this information and maybe I'm presenting something for level 3 or level 4, it will not be relevant to you as an individual, as a person who is just starting your CPA journey. So it's the same thing with the users of accounting information. As accountants, we have to ensure that as we provide this information, it is relevant to the people who are going to use it. And that they should be able to make decisions out of this information with high sense levels of confidence, understanding that the information is relevant to them, okay? Then we have the faithful representation, We have the faithful representation. Here, we are saying that information that is presented should be complete, meaning you don't leave out some information, you don't provide information that does not meet all the requirements. Complete means that anyone who asks questions of where, when, how, can easily be able to answer those questions by looking at the accounting information. So completeness is very key. Understandable accounting information should be provided in a way that 1 to or more people can understand and interpret the information in the same way. And that's why we have accounting standards. And that's why we have standards that even provide us with how we should prepare financial statements. If I look at the financial statements of Amazon or Facebook, these are companies that are not in Uganda, I'm able to interpret them and understand them because there's a systematic way of how this information is presented. So that is one aspect when it comes to faithful presentation. Realistic means you're not valuing a building which we expect to be valued at maybe 2 billion, you're valuing it at 20 million, okay? 20 million may not be able to build a certain building. If it's land, you're not overvaluing it or you're not undervaluing it, but you're giving a realistic valuation. Okay, so that is very important when it comes to this aspect of faithful representation. Now, we also have the other, what would call the other X-sticks. Now, these are the fundamental, the fundamental X-sticks of financial accounting information are these two. Then we have what we call enhancing, okay? We have what we call enhancing X-sticks of accounting information. Now, the enhancing, or what you'd call secondary, okay? Because these ones, relevancy and faithful presentation are the fundamental, are the primary X-sticks. And then we have the enhancing. It's very important for you to note that the fundamental X-sticks is relevancy and faithful representation. Now, starting from this one, consistency, verifiability, and so on, these ones are called secondary or enhancing qualitative X-sticks. So it's very important to distinguish the two. Usually the examiner can ask you qualitative X-sticks of accounting information, or sometimes they are a bit specific. They can ask and say, please provide the fundamental X-sticks. So those that are enhancing, let's start with one, which is consistency and comparability. Now, consistency means that what you do in year one in 2020 will move to 2021, will move to 2022. You're doing the same thing over and over time. You're consistent, from just the word consistent, okay? Now, as we proceed through financial accounting, you realize that there are certain things that we do. For example, depreciation. When we are depreciating our assets, we may have a method that we use. Maybe we use the method of straight line method in depreciating. You'll be able to learn these things as we proceed. You're not going to use straight line method this year. Next year, use reducing balance. The other year, use sum of digits method. You're not consistent. Or if they use 10% as your depreciation percentage, the next year use 30%, the other year use 40%. You're not consistent. So there's an aspect of consistency. And also consistency is not just within a period, like I said, 2020, 2021, but it could also be across entities. If we have an organization that has branches or has subsidiaries, a case in example, we have MTN Uganda, MTN South Africa, MTN Ghana, MTN Nigeria. If they are preparing financial statements for these entities, there is need for some level of consistency. When preparing financial statements for these subsidiaries, there is need for some level of consistency, because at the end of the day, you'd want to have a consolidated financial statement, financial statements that represent the whole entity. Now, if what you've done in Uganda is totally different to what you've done in Nigeria and different from how you prepared financial statements for South Africa, you'll not even be able to compare these entities. You'll not even be able to prepare consolidated financial statements for all these entities. And that's why you see consistency and comparability work hand in hand. Because if you're not consistent, you cannot compare periods. If you prepared financial statements different in 2020 and now you're preparing them different in 2022 or 2023, you'll not be able to compare yourself across the periods. The same thing with location. If you've done things differently for Tanzania and you've done totally different things for Uganda, it's not consistent. Maybe looking at international level could be at a high end. But even if there are branches, you run a bank and you have different branches. If you're looking at their financial statements, they need to be consistent. One branch should not be depreciating their assets using one method and another branch is, because at the end of the day, you want to compare them. You want to see which branch is performing better than the other, or you want to see which subsidiary is performing better than the other. But also entities want to compare themselves across even industries. If MTN wants to compare its performance with how Airtel is running, they can, because Airtel has financial statements. MTN also has financial statements, and you find some consistency in the way they are preparing information, because even the standards that we study, they help us get to this level, because we use the same standards. If we're using IS1, even the other people also use IS1. So that's why this aspect of consistency and comparability is very important for comparison purposes, okay? The other is, of course, verifiability. Verifiability means you can verify something. Now, today, if you came and you told me that this is our financial statement, this is our balance sheet, and you say that this building is worth 20 million, can I verify that? Is it verifiable? If you tell me that you made sales of 200 millions, if somebody came to your organization, can they verify that? And that's why we have the auditors, because the auditors now help us to verify whatever has been presented. So accounting information should be verifiable. You're not just preparing things without thinking about that these need to be verified, okay? So it's very important that as an accountant, you prepare information that is verifiable, meaning another third party or independent accountant can make and produce similar financial results from the same information, okay? Or an independent observer may be able to reach to the same consensus as how you're presenting. So verifiability is very key as another enhancing qualitative aesthetic of accounting information. All right, so the next one is timeliness. Now, as accountants, we provide information for decision making. It's very important that our information is provided in time. If a business wants to pay salaries, they want to understand how much do we have on the account, how much is expected to be coming through within this period. It should be provided at least before the time of salaries. If at all a business wants to make a decision in regards to buying a new asset, they need to be provided with information that can enable them make decisions as and when they need to make the decisions. So timeliness is very key. And you also need to provide, that's why we have, whenever we are providing accounting information, we put periods to it. We say financial statements for the period ABCD. We also bring in the aspect of timeliness. So timeliness is very key and very important to the users, because no one would want to use outdated information. Okay, important. Then the other we have is the understandability. Understandability, I already talked about understandability, and here my focus is to say that the information presented should be reasonable, should be in a format that somebody outside, the independent party, can understand it, can comprehend it. So that is why you see we have these standards that help us to align. We have a way of how we present our financial statements that even the URA person who is looking at taxing you understands your financial statements. They make sense. That's why we don't choose on how we prepare our financial statements. We have standard guidelines. So that's important. So those are the different X-sticks. Like again, I said these two, relevance and faithful presentation, are what we call the fundamental, and then consistency, comparability, verifiability, timeliness, and understandability are our enhancing. Usually consistency and comparability are written together because they are similar to each other. And then these other timeliness and understandability on their own. So that is important. Now, the next are what we call the elements of financial statements. The elements of financial statements. And also how we can be able to present, measure these financial statements. So before we again go into the elements of financial statements and so on, it's very important that you understand what are the financial statements. What are the financial statements? Now, the financial statements is, we have different financial statements. We have what we call, I'll just share my screen, another screen here. So we have the statement of financial position. We have the statement of financial position. We do have, and by the statement of financial position is also called the statement of, what is it called? It's also called the balance sheet, okay? So we have the statement of financial position. We have our statement of comprehensive income. Is also good to note. Then we have what we call the cash flow statement. And then we have what we call the statement of changes in equity. Now, when we say elements of financial statements, when we say elements of financial statements means that what do we record in these financial statements? What do we record in the financial statements? Now, a case in example, our statement of financial position usually records assets, liabilities, and equity. The statement of financial position, which is also the balance sheet, usually presents to show an organization's assets, liabilities, and equity as at the end of the financial period. So what does this mean? These are the elements of this statement of financial position. I'll just comment on the second one. Our statement of comprehensive income. Which is also called the income statement, and which is also called the profit or loss account. Okay. Usually looks at revenue and expenses. It usually looks at revenue and expenses. So what does this mean? It means that these are the elements of financial statements: the assets, the liabilities, equity, revenue, and expenses. If we go to look at our cash flow looks at cash inflows and cash outflows. Statement of changes in equity looks at equity. Now, cash flow is more focused on cash, which cash also falls under assets. Statement of changes in equity, its focus is on equity, which equity is right here. So the elements of financial statements we have are these 5 elements: assets, liabilities, equity, revenue, and expenses. So our goal here is to understand what are assets, what are liabilities, how do we recognize assets. Now, the word assets is very common to many of you, even if you've never attended a financial accounting class. You know that whenever somebody says that is my asset, they're speaking about something that has economic value and something that they're going to benefit from in the future. So that is the same thing with organizations. Organizations also have assets, okay? Organizations also have assets. An organization can own a motor vehicle. An organization can own land. So our assets are classified into 2. We have what we call current and non-current assets. And usually the current assets are assets that are going to remain in existence for a period below 12 months. Basically, assets that you're going to use within 1 year. And some of those examples of such assets, we have cash, we have inventory, which is also called stock. We also have accounts receivable, who are also called debtors. We shall understand all those. But for today, it's very good that you understand this definition, because this is a standard definition as provided by the Conceptual Framework. So as provided by the Conceptual Framework, an asset is a resource controlled by an entity. Now, the word control is very important, and it's very good for you to even underline. You having an asset, you driving that vehicle of your father, of your friend, doesn't mean that you have control over. Control means that you can make decisions about that asset and no one will have an issue with it. So organizations also only regard assets that they can control. So controlled by an entity as a result of past events or transaction. Usually assets are assets either you have earned through, you've purchased them previously. Maybe somebody has given them as a gift to you. It's also a transaction that has come through. Maybe it was a loan, so you loaned somebody money and it was security and they forfeited, so you got it in return. They should be a past event. If you're going to get that asset in the future, for example, you own a vehicle and you only get its logo book after 2 years, you can't regard that as an asset now because that will be a future event. And again, we are also saying that from which economic benefits are expected. Now, an asset, anything that has no economic benefit in the future wouldn't be classified as an asset. If you're not going to benefit from something in the future, it's not an asset to you. So future economic benefits are expected to flow to an entity. This is very important in part of our definition. So in simple terms, an asset is a resource. Sometimes we even go ahead to call this an economic resource controlled by an entity as a result of past events or transactions from which future economic benefits are expected to flow to the entity. This is a standard definition. You cannot come up with your own definition. It's a standard definition as per the conceptual framework. So it's very good for you to understand it and be able to define it. Don't just cram, but understand it. Understand the keywords in the definition. And once you understand the keywords in the definition, it can help you to define it as and when you're asked by the examiner. Okay? So that is very important. Now, the extics of an asset, and the examiner can actually ask you these extics. They are basically coming from the definition, okay? Because we said from which future economic benefits are expected to flow. So any asset, one of the essential extic is that there should be a future economic benefit that is expected to flow to the entity. That is it. Okay? Then the other one is gives an entity control, not ownership of economic benefits. We said a resource controlled by an entity. So this aspect of control, not ownership, we'll be able to appreciate it as we go ahead, but I'll give you an example. In Buganda here, Uganda, for perspectives of my friends who are not from Uganda, we have what we call Kabaka land. And you actually pay an amount of money to buy Kabaka's land. But they will tell you that that land is for the Kabaka. But it's your land, there's even a building on it. You can choose to say, I'm going to plant maize on this land, I'm going to construct a house. It is land. Now the question will be, do I call this an asset? Or I wouldn't call it as an asset. Here they are telling you that an asset is one that you have control over. You have control over the economic benefits. So you would regard that as an asset. Even when they say it's a Kabaka's land, you would regard it as an asset because you have bought, you've gained control over that asset. And you're going to have, because usually those leases are like 90 years, 40 years. So ideally they're assets, okay? They're assets. So we'll be able to understand that, but that is very key for you to understand. It's not just ownership, but as long as you have control. The land title may not be in your names, but you have the control. That is an asset. Then we have results from past events. Like I said, if something is just going to be earned in the future, then that is not yet an asset for you as an organization to recognize. If it is something that you expect that, okay, after you become 18 years or 25 years, that's when you have access to the asset. But that's not yet your asset. Or if at all it's a condition based for an organization, and maybe it's an asset that you expect to get. Maybe you lend somebody money and they are likely not to pay. You don't regard that as an asset unless you have actually gotten to that level, okay? So that's important. Now, recognition. When do we recognize an asset in our books? When we recognize an asset in our books? Two things. We recognize an asset in our books if it is probable, that future economic benefits will flow to the entity. Okay. And sorry, I had moved to another. An asset is recognized if it's probable that future economic benefits will flow to the entity. And we are looking at an aspect of 50% probability. So as long as there is that likelihood, because for example, today you have a motor vehicle and you're saying it is an asset because you think you're going to use it to generate income, it is an asset. But doesn't mean 100% because the vehicle might break down and you may not benefit from it. So we are taking into consideration that, but we are saying that at least there should be 50% and above probability that when that you're going to benefit from that asset, okay? Then the other is the asset has a cost of value that can be measured reliably. An asset has a cost of value that can be measured reliably. So it's very important that it's very important that you know these two requirements, okay? That you take into consideration these requirements of probable and the assets having value. Let's move to the next one, which is liabilities. But I do believe that you've understood when it comes to the different assets that we do have, like what I tried to say. I said that we have what we call non-current assets, which are also called fixed assets, or it's called fixed assets or long-term assets. Okay. And then we also have what we call We also have what we call current assets. Sometimes they also call them short-term assets, okay? Short-term assets. So some of the examples of non-current assets we have, like I said, we have land, we have building, we have equipment, we can have motor vehicle, and so on. Even we have computers, sometimes these are classified independently. So these are your current, those are non-current assets. Now, current assets, I said, for these, when you look at them, they will stay in the business for a period beyond 12 months. If you're looking at short-term assets, you're looking at assets like cash, bank. Cash is what you have in the cash box, okay? Cash, what you have in terms of cash. Bank is what you have in your bank account as a business. Can have inventory. Inventory is stock. Those things, those items you're going to sell. Maybe you're in a trading business, you deal in buy and sell. Or you're in a manufacturing business where you have raw materials. So in case you end the year and you have some raw materials that are not used, those will be part of your inventory or stock. And then we do have accounts receivable. These are also called debtors. Okay, some people also just remove the word accounts and call it receivables. So those are also as part of our assets, but classified as under here. As we proceed, we'll be able to learn more of what else can appear there. So these are the two classes of assets. You also understand that we have what we call depreciation, which is accounting for the loss in value of an asset. And we usually do depreciation at the end of the year. The depreciation is only for assets that are non-current. It's only for assets that are non-current. We don't depreciate current assets, okay? I also want to emphasize here that in terms of classification here, it also varies. Land to a real estate company. Land to a real estate company can be inventory. Why? Because a real estate company exists to sell land and buildings. So it's not a non-current asset for them. They're not keeping it for 10 years, 5 years. Theirs is buy land, 2 months, get a buyer, sell. So that is a current asset in that capacity. So it's very good for you to conceptualize and understand these things. Okay. Even vehicles, if we are looking at a vehicle from the perspective of a company that deals in motor vehicles, like companies that do companies that sell motor vehicles that is their inventory, because that is what they sell. So you'll see that the motor vehicles will not be here, but they will actually be here under current assets because it is part of what they sell. Okay. So it's very important. So 12 months beyond, under 12 months. Okay. So that's very important. Any questions? Not yet as per now. So I'll move to the other new element, which is liabilities. And for liabilities, what I'm going to basically say is that liabilities are the opposite of assets. Liabilities are defined as the present obligation. Liabilities are defined as the present obligation of an entity arising from past events. You see, for assets, we said it's a resource, it's an economic resource. But now here they are telling you it is a present obligation from of the entity arising from past events. So it should also be from past events, not a court ruling that you expect to happen in 2 months' time and you say that is a liability for me. It should have happened in the past. And they're saying that the settlement of which is expected to result in an outflow from the entity. Settlement of which is expected to result in an outflow from the entity. From the entity of resources representing economic benefits. Of resources representing economic benefits. Now, I want to give you something more that can help you in regards to this definition. You can write this. You can write this instead. Just note it down. Note down and say a liability is a present obligation. Already we have this. A liability is a present obligation of the entity arising from past events or transactions. Arising from past events or transactions. The settlement of which is expected to result in an outflow. The settlement of which is expected to result in an outflow. The settlement of which is expected to result in an outflow. So after this outflow, I want you to say this. I want you to say embodying outflow from the entity expected to result in an outflow from an entity of resources. I'm going to give you the statement starting from here, sorry. So after resources, write embodying economic, instead of representing, call it embodying economic benefits. And embodying is basically, let me just try to, it's just another word of to mean representing. Embodying is EMBODYING. I can just write it here in embodying. Okay, So some definitions will, instead of representing, will have the word embodying. Okay, so there will be liabilities defined as a present obligation of an entity arising from past events or transactions, the settlement of which is expected to result in an outflow from an entity of resources, embodying economic benefits. So that is how some literature will define it. So once we understand the definition, as you can see, it is structured in a way very similar to how an asset is defined. But again, the keywords here, it should be a present obligation, not something for the past. Okay, a present obligation that is arising from the past. Present obligation means that like you're demanded today. It's not again, I was demanded previously. So it's a present obligation, but from past events, okay? So present obligations, but from past events. Now, the settlement of which is embodying economic resources means that when you settle that liability, you're going to have something that you have to let go. That's what we call embodying economic benefits. So that's why you see when you come to the X-ticks here of your liabilities, they are picking out the keywords. The present obligation is a keyword. Resulting in outflow of resources is also a keyword, or embodying economic resources. And it should be from past events. It should be from past events. Are we together? So this is very good for us to note. Those three are the X-ticks of this. Now, in the same way, recognition criteria, liabilities are recognized if we meet these two recognition criteria. And this is as per the conceptual framework. These are not my words. They are not any other accountant's words, but they are words of the conceptual framework. So one, it is probable that future economic benefits will outflow as a result of settling present obligation. So if a given scenario does not, the probability that you've settled, that future economic benefits will outflow the organization, if the probability is low, is below 50, then it's not probable. Okay? For example, if you're going to win a case, you cannot say that you're going to, if you have all the facts to represent that you're going to win a case, okay? Now that is future oriented, but that's just to give you an example. The probability that you're going to pay for that obligation is very small, is very little. So it's not a valid liability. And then the other is the amount at which the settlement will take place can be reliably measured. You cannot just say, I think it might be like 50,000 or 70 million or 10 million. Like you're not sure. So there should be a reliable estimate for you to recognize that liability. Okay. So once we have that in mind, I want us to just appreciate also what happens with liabilities, okay? I want us to appreciate what happens with liabilities. So in the same way liabilities, we have what we call current and non-current liabilities. So we have our current and non-current liabilities. So the current, we have accounts payable. These are usually your creditors. And you can also have short-term loans. And you can also go ahead to have bank overdrafts. Usually these liabilities are liabilities you can settle within a period of 12 months. And then non-current liabilities, we usually have long-term loans. These are usually above 1 year, 1 year to maybe 5 years or 10 years and above. Even if it's 20 years, those are long-term loans and they will appear under non-current liabilities. And then you can also have debenture. Okay, debenture is also another long-term liability. We shall be able to learn more even as we proceed, as we go through our study. Okay. So that is the second element of financial statements. And then we have the next one, which is equity. Like I said, the first three are those that are usually represented in the balance sheet. So we have looked at the assets, now liabilities. Now it's very good for us to look at equity. Now, equity is owner's contribution to the business in layman's language, but it encompasses other aspects, okay? And from the conceptual framework perspective, equity is defined as the residual interest in the assets of an entity after deduction of all its liabilities. So the equity is assets is minus liabilities. This is also called the accounting equation. We are going to see how the effect of transactions on the accounting equation. But this is just to give you why they say residual interest. What remains when you subtract your obligations from your assets is what we call equity, okay? So for small businesses, equity is mainly capital. But for larger entities, equity encompasses other items. When you're presenting your statement of financial position, you have your capital. Usually for corporate entities, we even add the word share capital, but we also have other elements of equity. For example, share premium, okay? Share premium is a situation where an organization sells their shares at a price above the market price. For example, if the shares of MTN were 100 shillings and these were sold, okay, I think MTN shares were 200 at the time of selling them, but these were sold at 300. 300. That means they are sold at a higher price than their nominal value of 200. So the difference will be a share premium. We will see how that comes. We have also retained earnings. Now, retained earnings, this is basically sometimes some literature may call it accumulated profits. Retained earnings are the profits that the business has been making in the previous period. Basically, what has been retained within the business are not distributed out to the owners, okay? And then we have reserves. These reserves can be general, but also can be specific reserves, and so on. Usually even the adjustment of drawings, especially for small enterprises, sole proprietorship enterprises, usually drawings are accounted for under equity. But this is not something I want to leave here. So these are the equity items. So what they're trying to say is that for you to determine an organization's equity, get the total assets as they are. Add, of course, total assets is adding current assets and non-current assets, and less liabilities, the total liabilities. You should be able to come to your equity. We'll see how that comes into the picture as we proceed. Then we have the other element, which is called income or revenue. Now, I say that as assets, liabilities, and equity are presented in the statement of financial position, in the statement of comprehensive income, we have what we call revenue and expenses. We have what we call revenue and expenses. So according to the conceptual framework, revenue is defined as the increase in economic benefits, during the financial year in form of inflows. Now, inflows means customers are paying. And then they're also saying, or enhancement of assets. Now, when assets gain value, there's an income. Interest is an income because of enhancement of an asset. But also, revenue can also be in terms of decrease in liabilities. So revenue refers to an increase in economic benefits during the year in form of inflows or enhancement of assets, or decreases in liabilities that result in increase of equity. Now, when they say results in increase of equity, means that their effort, their understanding is it results in an increase in your retained earnings, okay? We're going to see that this when we do our accounting equation. So results in an increase in equity other than those relating to contributions from equity participants. So when the owner of the business contributes money to the business, maybe in the following year, we don't call it that an income. Incomes are only those that relate to these others. The increase in asset, enhancement in assets, decrease in liabilities, and so on. So this is how the conceptual framework defines revenue, okay? From layman language, you understand that revenue is what is earned as a result of transactions. When you sell, you earn, that is revenue, okay? That is revenue. They're also saying here, increase in cash via loan acquisition is not revenue. We know very well that increase in cash via loan acquisition is a liability, it's an increase in liability. Recognition criteria, we also have 2 of them. Now, there's a common recognition criteria on nearly all the elements, which is usually the aspect of the amount can be measured reliably. Now, here, the probability is on the inflow of economic benefits, okay? For it to recognize revenue, there should be a probability that economic benefits will occur or will flow within the organization, okay? That is important. Now, income is just one of the other. We also have expenses. Now, expenses are the reverse of incomes, and expenses for them, they are defined as the decrease in economic benefits. When you pay for example, this class, or pay for rent at your workplace, that is a decrease in economic benefits. There is an amount of money that is being paid out. So defined as a decrease in economic benefits during the accounting period in form of outflows or depletion of assets. As we proceed, we understand that there are some expenses that result from depletion of an asset. A case in example, depreciation. When assets depreciate, that's a depletion in an asset. Or increases in liabilities. Now, an expense is not just you saying you're picking money and paying. There are also scenarios where an asset is coming in terms of increase in liability. For example, if you don't pay rent for this month, you have a liability. And that liability will also result in an increase in an expense, okay? So you recognize the expense, but there is an increase in liability as well. And we're also saying that this also results in decrease in equity, other than that relates to distribution to equity partners. Distribution to equity partners are dividends. So here they're telling you that dividends are not expenses. When you get money, owners of business are distributing profits. Those are not expenses, okay? So we have recognition criteria here. Again, this recognition criteria, you'll see it very common on all the elements. Even when you go to let's say we saw that for income, we also saw that for liabilities, we also saw that for assets. At least it's one that you should not forget. So recognition is very key. Now, expenses are recognized when there's probability that outflows of economic benefits will occur. In the future, you will have to settle for that expense. Recognize it on that basis, or the amount will be measured reliably. So it's very good here that even going ahead to give us some examples of expenses. Similar to what we had here for revenue, or income, some of our examples of income is including, wanted to show you something here. Examples of revenue include sales, fees, sales. When a business makes sales, that's income. When it charges fees, maybe it's KCCA charging fees, or it's a school charging fees, that is also income. Commission is earned, for example, when they sell on behalf of another organization, that is income. Interest may be income on bank accounts. Maybe you have a fixed deposit account and there's interest. That is something that comes through. And then we have rent received. You know, rent can be an expense, but it can also be an income. So when you come to your expenses, we have these examples: wages or salaries. When employees are paid, that's an expense to the company. Rent, either it is office rent or factory rent, it's an expense. Interest, now the interest here they're talking about is not the other interest we've seen where it is you benefiting. This interest is when you have a liability. Let's say bank loan, and you're the one who is settling interest. We have electricity, utilities are also part of expenses, and so on, okay? So those are our elements of financial statements, and you'll see them the way they are presented in our statement of comprehensive income. So we've at least understood some of the examples. Fees, we have sales, commission, interest received, expenses we've also gotten some examples. So at the end of the day, of course, after you get your revenue, you less expenses, you should be able to come to a profit or loss. We are going to see how the formats of each of these financial statements look like as we proceed with our class. I don't know if you have any questions so far on where we have reached. Please.
Yes.
Please, Maureen, proceed.
Thank you, sir. My question is there a scenario where penalties can be considered as under income for any entity?
Okay, maybe just ask penalties when it is the entity that is penalizing.
Yes.
Not penalized.
No, when the entity is penalizing.
When the entity is penalizing, that would be income in case it meets the requirements in terms of because we say that for revenue to be recognized, we have two requirements. It should be probable, okay, that an inflow of economic benefits will occur. So the penalty has a contractual or a contract behind it. Okay, and then probable is one of them, and then the penalty can be measured reliably. So if a company has already even received the penalty, we recognize that as our other incomes when we are doing our P&L. Are we together?
Yes, thank you.
Yeah, you're welcome. So that was one of the questions. Do we have any other question other than that? Okay, so we don't have any question. I'm going to be able to respond to some questions here within the chat box. We have about a few minutes to the end of this class. Somebody asked this question and said, is it only me who thinks that this pace is relatively slower given the topics and on the course outline? So I would want to respond to this saying that when I'm teaching this class, I understand that not all of us have an accounting background. But I also understand there are people who are attending these classes who have accounting backgrounds, who have done financial accounting at different levels. So some of these things may be boring to you. But to a student who has never studied accounting, who is a lawyer, who wants to become certified, these things are totally new for them. So I take time to labor to explain and provide you with a good foundation. There are topics that I'm going to reach on, and I'm going to be going fast, but I won't only go fast when I know that at least we've understood the concepts, we've understood the foundation. So that's why I labor to provide a more elaborative foundation on these concepts. Even for you who already knows these things, there are things that you can be able to pick up and understand, okay? In terms of coverage, I want to give you the confidence that we shall be able to cover. And for you, my online students, some of you that have been part of my classes previously, I've handled this paper for quite a good number of years. And even for the previous sittings, we have some recordings that I'll even be able to provide to you to boost up your preparations, to see that you're not being left behind. So I have the strategies that I've been able to lay down that I think we are on track, and we should be able to cover the topics. But it's very good for us not to just rush into the topics, because we want to finish when some people are not understanding. So that is why I've taken that approach, and that's why I'm laboring to take a lot of time explaining these things so that students can be able to get it. So I hope that is, Azalia, that gives you a highlight of why we're progressing like this. So that's my comment. Any other question? Maybe other than that. Now, at least we've gotten an understanding because we've been able to look at the introduction bit, the elements, financial accounting, and so on. Now, when we get into ledgers, okay, when we get into trial balance, preparation of financial statements, these things will be very, very familiar to you because you understand them. So this is just theoretical. I know we've not started the numbers, but we are starting the numbers anytime soon. Okay, next class, we should be able to start on the numbers. We're going to calculate, we're going to do double entry, and you'll be able to appreciate why we have labored to go through all these, okay? So that is very important. Today we started some minutes late because of some logistical issues, but we should be able to take on things at a good pace. I encourage you to join in early. And I'm also I shared these notes already. There are some areas that we have covered and some areas that we are not covered, but shall be able to cover those along the journey. So I don't know if we have any questions for now. Okay. Yafet, you've put up your hand. Please unmute and ask.
Okay, it is not the actual question, but I did not get the recordings of the last lesson.
Okay. Yafet, I shared the recording. Maybe before you join the group, I'll be able to re-forward that to you. Just send me a WhatsApp and say, share with me the recording of the previous class, and I'll be able to share that with you. I also uploaded that recording on my YouTube channel. It's a public channel, and I don't of course publish every class there, but I just do share some of the beginning videos for your access, so you can be able to find it on the channel there. It's the channel of Coach, I think it's Accounting Coach. I uploaded it. Let me just try to see if I can share my screen so you can see it. So there's this channel. I did an introduction for financial accounting and posted this video. I'll not post this, the one we've done today. It's only for students who have been able to pay. So we want to understand. So you'll be able to find this right there. Okay, I can just drop also the link in the chat box. You just copy it. There are also other videos that I've put here, but they are random videos. For you, my students, I'll give you a document that has arranged information that can help you accordingly. So I believe we'll be able to walk this journey together, and you definitely excel. Okay? You definitely excel. So this, don't worry about the pace, leave that for me. It's just to be inclusive for my students who have no totally accounting background to understand these things. As they seem to be very obvious, some of you, they are not obvious to many people. So it's very important that we take time, we are patient. We also appreciate there are things that you may take for granted, but there are things that I comment about here that are not just for commenting, but they will feed into what we shall study even as we proceed, okay? Because even when we get to preparation of financial statements, you need to be able to understand, where do these assets come from and why do we have them here? What is an asset, okay? Like I explained and said that a motor vehicle can actually be a current asset, but can also be a non-current asset. Now, such information is not, if somebody just crumbs and says motor vehicles are usually non-current assets, somebody may not understand that sometimes these motor vehicles are actually the inventory of the organization. Now, something like that, you cannot understand it unless we go in depth to some of these things, okay? Yeah. So that is to do with our introduction. So at least you appreciate some of these things and where we are coming from. And once you also read through the notes, they'll also be very helpful. I'll share with you some guiding notes, videos that will help you along with your study to see that you excel. Here we teach people who excel. My students get 90s, they get 80s. And my goal for every student is at least a minimum of 75. So let's put in the work. Let's ensure we attend all these classes. When I give you assignments, ensure that you do them. Okay. So allow me end this class here. I'll be able to share with you some materials on the WhatsApp group. Whatever I share, please take your time to go through them. They'll build on to our next class. So thanks for joining in, and I wish you all the best in the rest of the day.